We've been getting consistent earnings beats from Canada's big banks, despite concerns over the economy. Let's get more from Richard Croft, Chairman and CEO at Croft Financial Group. Richard, thanks very much for joining us. Kind of surprising, isn't it, given the threat to our economy with these tariff walls that Trump has erected?
Yeah, well, there's a broader picture there, I think. First of all, the banks, if we have a slowing economy, you're going to get lower interest rates, which improves their net interest margins. If you get a more robust economy because they get some sort of deal in place with the USMCA, that's going to be good for loan growth, and it's going to reduce their bad loan, money they're setting aside for reserves. That reserve money that they're setting aside, of all of which they did and added to, I think gives them a pretty strong defensive position next year, no matter what happens, because I think they're going to benefit either way. The other thing going on here, I think, is that the Canadian banks have a lot of exposure. Certainly the ones that have reported, Royal, TD, Bank of Montreal, and to a lesser extent, Bank of Nova Scotia, have very good business models down in the U.S. So even if the U.S. economy does better and we suffer, they're still going to benefit from some of those things. I think they got a lot of things going for them. There's a lot of tailwinds going into 26.
That's interesting. Even with a weaker economy, interest rates tend to come down, and that's good for their spread, their net interest margin.
Exactly. And if they have a stronger economy, they can lower their reserves. It's a wonderful business because you can manage your earnings so effectively. Raising your reserves manages your amount of earnings in a particular quarter. And of course, if you lower your reserves, that bumps up your earnings. So I think they're in a very good position. They certainly have great capital ratios. And I'll tell you one of the things that struck me with some comments that came from David McKay at Royal Bank, and RBC is trying to get their return on equity up to around 17%. That's a pretty stellar number for any bank. And one of the ways they're doing that is that they have embraced AI a lot more than the other banks have. And I think that you're going to see more of that play into this over the next year. It's one of the rare instances where you're seeing artificial intelligence actually benefit the bottom line of a company at this stage of the development of that era. So it's interesting to me.
Do you think the politicians will ever get the backbone to really go after competition among banks? The Competition Bureau in September of 2024 said that we do have a financial sector that needs more competition, highly concentrated, and it's tough to switch providers. And now the budget talked a bit about that, but do you think Ottawa, I mean, the banks have such lobbying power in Ottawa. Do you think they ever will try to break up what many people think is an oligopoly?
I think it's going to be a very big challenge, and I don't think we're going to see it in our lifetime. One of the issues that I have always looked at with the Canadian banks is that Canadians in general prefer the stability that they bring to the table, and they're willing to accept less competition for greater stability. So I think that's where we are at this stage, and that's the psyche of Canadians to start with. Americans went through an awful time during the financial crisis, and part of the problem was they had too many banks, and a lot of them weren't very solvent. So yeah, I don't think we want that here.
I don't know. I just think, shouldn't it be nature red in tooth and claw? Is it that bad if a bank goes bust? I mean, we have deposit insurance protecting the public, consumers.
Well, we have $100,000 in top profit. I don't know how much that really defends anybody. That $100,000 that they had in place, I mean, I think it's 100 or 150. I kind of forget what it was in the States. But when Silicon Valley Bank went under, there was none of those depositors, most of them, because they were quite wealthy, would have been got their money back. Now, the problem here is I don't think the government has that kind of money anyways. At the end of the day, they'd have to merge that bank with somebody else. So somebody's got to take it over. There goes your competitive edge all over again. You're back to smaller, bigger banks with a smaller group, which, to tell you the truth, is what they did after the financial crisis in the U.S. I mean, Goldman Sachs became a bank, and it was a really, really big bank. And it wasn't that before. So I think we've got more concentration in the U.S. too, because I think they see the value of that relative to the risks involved. Let's face it, the banks become the lubricant of the engine that drives the economy. That's really what it's all about. And if you have stability there, that's what you want. You want an engine that works fine.
I know I'm dwelling on this, but you say lubricant, or are the Canadian banks really sand in the works because they're so conservative with their lending? They won't back entrepreneurs.
Yeah. Well, that's a fair comment. Yes, that's true. Having gone through that myself, yes, I agree with you there. Yeah.
I know, but I wonder.
The more competition would loosen that up, but also make it more risky. So, I mean, it's that trade-off, and that's what we look at as Canadians.
That's a
whole trade-off.
That's interesting. Yeah, you can't, there's no free lunch. Yeah, that's right. Sometimes.
Sorry, go ahead. No, you go ahead.
Richard, if somebody came to you, and this is a rhetorical question, and said, look, I'm just going to put all my money in Canadian banks, my entire equity portfolio. Yeah. What would you say to them?
I wouldn't discourage it entirely. I think they deserve a place in a portfolio. I think a portfolio should be diversified. I think one of the things you run into is when you get banks, you get a lot of stability, you get a very nice dividend, you've got some comfort that they're going to do all right over the longer term. And quite frankly, the portfolios that have had an excess amount of banks in our group of clients have done very well. On the other side of that, you would have missed some of the rallies that we've seen in gold. Agnico Eagle, for example, is doubled in this year, things like that. You would have missed most of the AI boom, which let's face it, that's a big part of where the growth is coming from. So it kind of depends where the client is at a particular point. If they're 65 and older, I say, sure, if you're going to have equities, that's a decent place to put it. But I think it still should be part of a diversified portfolio. I was going to say one thing, just about your segment there. You were talking about Meta, because they just actually wrote a piece on that. We're talking about the AI bubble. And one of the things is that I think investors are looking at that as a metaverse moment here. And Facebook got down to $112 in 2022.
Wow.
So it's $675 today. And that was because it was driven lower on the metaverse concept and the fact that he changed his tune and is putting more money. And I think what the industry is looking at is not just a metaverse example. I think they're going to look at, if you're going to invest in AI, I think there's going to be more scrutiny in 2026 in terms of the value you're getting out of that, which goes back to my point on RBC. I think they're getting some value out of the AI, and that increase in margin is a big deal. I think that's one of your themes that's going to play out in 2026 across the spectrum, and we're going to see if AI can fulfill the promises, because I think that's what clients are looking for, investors in general are looking for.
It's interesting. Yeah. The people are going to be more skeptical, as you say, about the billions that are being poured into this stuff. Thank you very much, Richard. Really appreciate it.
No problem. Good seeing you.
Richard Croft, Chairman and CEO at Croft Financial Group.